We've got another great interview for you guys today. It's Douglas Rushkoff. He's got a new book, Throwing Rocks at the Google Bus. But if you don't know him, you should. That's why we do these interviews. He's been writing about media, technology, and culture for a long time. He's credited with coming up with terms like viral media. You might have heard of that. And digital native and social currency. He's got a great number of books, but I'm going to give you two titles from the books. 2009, Life Incorporated, How the World Became a Corporation and How to Take It Back. There's no way I'm not interested in that. In 1999, he wrote Coercion, Why We Listen to What They Say. I love that as well. And then a bunch of documentaries, two more titles I love. 2004, The Persuaders. 2001, Merchants of Cool, How Things Are Made Cool by Marketers. So, Douglas, thank you for joining us on the Young Turks. Can't wait to talk about this. Yeah, absolutely. So let's get started with your new book. What is the Google bus and why are we throwing rocks at it?
Well, the real Google bus is the bus that, or the many buses that take Google's workers from San Francisco, the picturesque city where they want to live, to the Google campus, which is an hour or so south of the city. And what's happened is so many young tech workers have moved into San Francisco, the rents have gone up, it's kind of a gentrification on steroids situation. And a lot of the people who've lived there for many years, a lot of the local businesses have had to leave. And they found that in the areas right around the Google bus stops, that rents are even another 30% higher than they are in the rest of the town where they've already doubled or tripled. So they've become a real symbol for the way that these companies, which originally seemed like the people's companies, that these were the ones that were going to really distribute wealth and all sorts of new opportunities to real people in real places, that they've actually tended to extract more value than they create and not distribute the money that they're making in any way that really promotes economic activity.
You talk about growth and prosperity in as if they're separate things, but we've been led to believe for many years that they're the same thing, that if you have growth, you're going to have prosperity, and that when you have prosperity, that it's prosperity for many people and not just some. So walk us through why you think that might not be the case.
You know, for the last 75 years, corporate profit over growth has been going down. That means the way that corporations are structured, they're really good at vacuuming out the value from people and places. They're really good at accumulating, at growing, but they're really bad at deploying the money that they've earned. So they're getting really fat. They're sort of obese with cash, but they don't know how to spend the cash in ways that create revenue, in ways that create business. But right now, the way business is structured is that if you make revenue, you get taxed really high. If you make revenue, it's seen actually kind of as a bad thing. All you really want to do is grow. But when you value growth over everything else, you end up with these colossal companies that can't really do anything. Pharmaceutical companies can't make up new drugs. They have to acquire little pharmaceutical companies that know how to do it. Even Google now, it turns itself into Alphabet, which is a holding company. So Google now is supposed to make its money by buying and selling smaller technology companies rather than innovating from within.
Why is that? Why can't... I was led to believe that we needed to give monopolies to the big drug companies for years on end so they could have enough money to innovate. Now you tell me that they have too much money and hence can't innovate. What's going on?
It's ironic, isn't it? You know, but it's because they're valuing really shareholder growth over creating economic activity. So another way to look at it would be Walmart. So if Walmart wants to grow, it goes to a town, it'll run all the local merchants out of business, it'll undercut everybody until there's no one left but themselves. And then they can hire people part-time so that their workers have to go on welfare and the welfare state gets larger. And eventually, after 20, 30, 40 years, the town where Walmart is trying to operate goes bankrupt. There's no revenue, there's no customers. And that's what's happening now. A lot of them are going out of business because they've sucked all of the value out of the places where they're operating. You know, it's the same tactic that an Amazon or an Uber uses, where Amazon doesn't really care about the book industry. They just see it as the low-hanging fruit in order to establish a monopoly, but not just a monopoly in books. They want to use that monopoly in books to move over into another vertical, whether it's drones or fulfillment or logistics or robots, whatever it is that they're going to build. So if you look at your marketplace as really the way a colonial empire looks in a new territory, as something to conquer and suck all the value out of the ground and out of the labor, then you don't have a sustainable business. Where instead, if you look at your marketplace, this is what I'm arguing companies should do anyway, if you look at your marketplace as a place to keep alive, as people to make rich, then you have wealthy customers, and then you have some ability to move towards a sustainable future.
But we've been led to believe that capitalism is efficient and it does things through the invisible hand of the market in a way that is going to bring maximum utility. So what's going wrong in the equation that it's not doing that?
I mean, partly it's that capitalism and the market are two different things. That there's three real factors of production, according to everyone from Adam Smith on back: land, labor, and capital. That's what you need to have production. But in the marketplace like ours today, we only value capital. A young person comes up with a great idea for an app or something that's going to help people or be ride sharing, so people can now go in each other's cars and save energy. Now, once capital comes in the form of VC, nobody's listening to the labor. Nobody's listening to the places where the app is operating. Everybody listens to the VC. And what does the VC do? They say, come on, guys, you have to pivot. And pivoting is really a nice way of saying, leave that nice business you are going to do, and instead, let's figure out a way to get this company acquired or to IPO in the next 18 to 24 months. So that means we're going to surrender the value creation of this app in order to grow, in order to establish a monopoly that we can flip. So it's kind of the flip this house model of business that leaves kind of scorched earth devastation in its wake rather than economic prosperity.
So it seems to me that we're talking about two things here, not necessarily different things, but two things. One is the macro look at how the markets are functioning in America right now and perhaps all over the world. The other is the one you just mentioned about the VCs and the new model of flipping things in 18 to 24 months. So let's talk about that for 1 second, because I have some experience with that, and I find it to be insane. And so I wanted to see if you could verify its insanity for me. It seems to me that the whole new marketplace where people invest, oftentimes in tech, but not necessarily just in tech, with an eye to get out in 18 to 24 months, as you just talked about there, at maximum return within that time period, sets up a house of cards. Because almost every single company built on that structure is set to explode. That you grow, and then who cares about making money or profit or anything like that, or building a real business, and then somebody buys it, and then everybody who built that business, even if it's a really successful one, immediately has an incentive to get the hell out of it because they already cashed out. And so every one of those businesses is set to collapse. Yeah. Am I seeing it wrong? Or it sounds mental.
No, this is the truth. I mean, and it's, in some ways, it's traditional corporate capitalism, but when you run it on digital steroids, the effects happen so much faster and in such a more extreme way. I remember when I saw, my friends, the founders of Twitter, on the cover of the Wall Street Journal with the numbers, 4.3 billion, 5.1 billion under their faces, the amount of money they made the day that company went public. I was happy for them because it's cool to know a billionaire, but I was also sad because I realized they had taken a potentially disruptive business and they surrendered it to the biggest, baddest industry of all. When the traders are applauding for you on the stock exchange and they let you ring the bell, it's not because you've done something disruptive. It's because you've confirmed the centrality of capital to the whole equation. And now look at Twitter. They make $500 million a quarter, and this is considered an abject failure by Wall Street because it stopped. Oh my gosh, an app that has 140 characters, that's what Twitter is, a 140 character messaging app, makes $2 billion a year, and they're not allowed to consider that a success. This is a failure because the growth has stopped. And if we have to grow businesses, If we have to grow capital at the expense of land and labor, then look what happens. We get unemployed people and we get climate change. It's pretty obvious what's happening.
So now we're going to move on to the harder issue of how to fix it. And look, I probably shouldn't say this, but I will because it's the Young Turks. But we've gone through this. So when we go to raise money, people go, no. The problem with you guys is you're building a real business. We're not at all interested, right? So you've been around online for 10 years, and you have real customers, and you have real viewers, and you have everything is real. It's not a mirage. And it took 10 years. That's super annoying. I couldn't get my money out in 18 months. So we're not going to reward your success. Number one online news show. With almost no money, we beat CNN and everyone else, right? And the market goes, well, that's not, we hate it that it's a real business. So now in this insane topsy-turvy world, how do you get money? How do you fix the system if it's all built on having the investment in the first place to grow your businesses?
Well, I guess it depends. I mean, in some cases, it's a matter of not taking the money, because once you take the money, it's like selling your business to the mob. Now they're in charge of the thing. And and I empathize. The minute you show revenue, it's a real problem, because if you show revenue, then it demonstrates that you're participating in the circulation of currency. Now you're committed to the velocity of money. You want to make your sponsors rich. You want to help promote the people who are on your show. You are growing in an incremental, natural fashion. That's part of the real value-creating economy. And that's anathema to people who are in business to sell the business, to flip the actual company. And it's partly because, and I think it'll flip. This is partly the result of the sort of the 1990s Jack Welch approach to business. He was the famous CEO of GE, who realized that General Electric may make 5, 10, 20% on their investment in creating washing machines, but they'll make 30, 40% lending money to people to buy those washing machines. So he said, aha, let's sell our productive businesses and get into lending. So GE became more of a financial firm than it was a building firm. And now they're finally reversing that, because after 2008, people realized, wait a minute, this finance thing just doesn't work. It doesn't add up. It is a Ponzi scheme. I mean, Madoff was caught for it, but it's really all of that. It's just, you have to choose. If my company, if the thing I've built is just going to be the name on another Ponzi, then you're going to go get that kind of money. Otherwise, if it's going to be a productive business, you almost have to bootstrap that business and use the revenues in order to grow slowly. And if anything, then find people who understand that they can invest for real in something rather than trade it. So you're going to have to adopt different models, go to different kinds of funders, and then consider whether that funding is really absolutely necessary in order for you to get to the next stage, if there is a next stage that you even want to get to. There's a certain point at which you say, well, I like working for a living. This is cool. I'm actually doing okay.
So, I mean, you've described almost to a T what we actually did. So, God bless. So, we're okay. But what do we do now to the even larger and more difficult problem of solving this on a macro level?
Well, it's going to be tricky. I mean, there's a lot of different moving pieces. I mean, politically speaking, I think people have to understand that the landscape itself is optimized for the extraction of capital. So you look at something as simple as the tax code. Capital gains are taxed very low. Actual payroll and dividends are taxed really high. How can you take the economy on a macro level and encourage real economic activity if you're punishing it with a tax code? So the first thing you need to do is reverse those. So you optimize the economy for the velocity of money rather than the extraction of money. Second, you've got to start, businesses have to start doing experiments in value creation. They have to ask whether just robbing their markets of money is going to be a good long-term strategy. I talk to lots of CEOs, and they understand that they are cannibalizing their businesses because they have to show quarter-over-quarter growth. And they would love to be able to turn to a revenue-based, dividend-based model where they make their shareholders rich for holding the shares. But again, it's tricky if you have a tax code that's biased against that. Another thing we have to do is understand that these rules of investing are not the conditions of nature. This is not, God didn't make it like this, but that we have a marketplace. This is why I had to write a whole book on it. But we had a marketplace where the rules were put in place by monarchs in the 12th and 13th century for very specific reasons that had to do with colonial expansion and how chartered monopolies would work and how they could make money by lending money from a central treasury. Those players have long since left the building. And their plan, their scheme for colonial expansion really reached its endpoint around Eisenhower's time. And we were able to use technology to kind of artificially increase the surface area of the planet to include human attention and human time instead of just physical territory and slaves and mined metals. But we've really reached the limits of that too. And now that we have a technology that's capable of doing distributed value creation, that's capable of letting us return to almost very highly distributed cottage industries where individuals create exchange value in a peer-to-peer fashion, we need to allow that to happen and build businesses optimized for that activity rather than building old school industrial style businesses. Our MIT economists, they wrote that book, The Second Machine Age, arguing that the digital is going to be a new industrial age. We can't do another industrial age. The industrial age was about disconnecting labor from the value they created. People no longer sold things, but they sold their time. They became employees. We don't need employees anymore. We don't even really need jobs anymore. If you continue to look at human beings for their utility value, we're going to lose. Machines will outdo us, no one will have work, and we're all going to go broke. If you start looking at the economy instead as something that's here to serve humans, to serve society, then you can begin to do very small tinkerings to enhance and encourage local economic activity, to promote bottom-up value creation, to allow people to do reinvestment in things that they see in their own lives rather than long-distance investment in companies that really just really hurt their own quality of life.
So then I've got to ask you one final question for now, which is, when you talk about that restructuring, I mean, yes, you mentioned the tax code as a possibility, but how else would we fundamentally restructure, given that right now the way we've written the code for corporations is maximize profit at all costs? And when you talk about the stock market, you're saying it's built from a different time, but wouldn't we always be looking for the bottom line in short intervals, whether it's a quarter, a year, a week, whatever it is? If you build machines to maximize profits and care about those profits on some short-term basis, isn't the system we have now inevitable?
If you valued profit, we'd be better off than valuing growth. Corporate profit is down, because they're looking just to grow. They don't actually grow through profitable activities. I mean, Amazon's not profitable. Tumblr wasn't a profitable company when it sold for $1 billion. If we actually returned in some ways to good old-fashioned fundamental business, how am I going to make money and use that money I've made to reinvest it in the company? That's such a good proof of concept. That's why Kickstarter is so interesting. Do people want this? So now we time shift risk. We don't need the investor anymore to be the one who gives risk. We can see, is there a market for this thing? So, in some ways it's so simple. It's just returning business to the true fundamentals and not looking at a business as something to sell, but rather a business as something to keep. The idea that it's somehow shameful to work for a living is the part that's really nuts today. Even the kids going to work at Google or Facebook, they want to do it for 3 or 4 years and somehow get it to some IPO or something that then they can coast the rest of their lives. So it's got to be okay to work for a living. It's got to be okay for the government to implement something like guaranteed minimum income, where we decide that if there's enough food and there's enough houses, rather than burning food every week to keep market prices high, rather than have B of A in California tearing down houses because they're in foreclosure, we could let people actually live in them. The only reason to have a job today is not because we need your work. It's not because we need your labor to somehow keep things going. It's so that we can justify letting you have a portion of what's already in abundance. And that's an ass backwardness that we're going to have to rethink if we want to live in an age where robots really can till the soil and pick the cotton.
Does this system have to collapse before we rebuild the one you're talking about?
I'm hoping it doesn't have to collapse. Luckily, the same things that you would do in order to prepare for that collapse are the exact things you would do in order to prevent that collapse. Create local resiliency. If you have a big corporation, start looking at experiments that allow you to help create value in communities rather than just extract it. And I've got tons of them in the book, from banks facilitating local crowdsourcing to Walmart putting a shelf of locally produced goods in their stores. I mean, there's a lot of ways to actually try to let people become rich rather than try to make them poor. Towns can implement local currencies. I mean, there's so many different things we can do to become more resilient and mitigate the effects of this sort of runaway, steroidal, centrifugal force of traditional corporate capitalism on digital steroids. But worst case, if the whole thing does crash, at least we'll have the beginnings of the instruments, the mechanisms that we need to survive when we don't have these long corporate-driven supply chains to bring us what we need.
Douglas Rushkoff, thank you so much for joining us on the Young Turks, and fantastic conversation. Everybody, the book is Throwing Rocks at the Google Bus. And Douglas, we'll have to definitely have you back on to continue this conversation, hopefully before the collapse, but if it does happen, definitely after the collapse on how to rebuild.
Excellent. It'll be fun if we're still here.
Well, we'll be here. TYT never goes away.